What is financial market? Financial markets are places where financial instruments are bought and sold, and prices are determined. In these markets, investors and institutions acquire capital or are exposed to risks by trading financial assets. Financial markets facilitate the flow of funds in the economy, encourage investments, ensure the efficient distribution of capital, and support economic growth. The fundamental functions of financial markets are as follows. Price determination. Prices are formed in financial markets based on the balance of supply and demand. These prices reflect the value of specific financial instruments and serve as a guide for investors. Fund transfer. Financial markets enable the transfer of funds from savers to investors. In this way, investors provide financing to support the growth of businesses and the implementation of projects. Risk. Distribution. Financial markets distribute risk among various participants, facilitating risk avoidance and management. For example, while one investor may invest in a particular financial instrument, others may opt for different instruments, thus reducing the overall level of risk. Price discovery. Financial markets facilitate the process of determining prices and discovering asset values. This allows investors and institutions to trade at the right prices and make informed decisions. Providing liquidity. Financial markets provide liquidity by allowing investors to buy and sell financial assets whenever they desire. This liquidity enables investors to meet urgent cash needs and diversify their portfolios. Financial markets typically include various financial instruments such as stocks, bonds, currencies, commodities, and derivatives. These markets operate on different platforms such as stock exchanges, over-the-counter OTC markets, futures exchanges, and forex markets. I will now inform you about the stock market, bond market, and forex market. 1. The stock market is a financial market where shares of companies are bought and sold, and investors engage in trading with the aim of capital growth or earning profits. In this market, companies can be either publicly traded or privately held. Publicly traded companies offer their shares to the public through an initial public offering, IPO, allowing investors to buy and sell these shares on the stock exchange. Private companies, on the other hand, typically do not list their shares on the stock exchange, but may trade their shares on private trading platforms or markets. Stock markets generally operate on exchanges, which are official marketplaces where stocks can be traded. For instance, major exchanges like the New York Stock Exchange, NYSE, or NASDAQ are among the world's most popular stock markets. The primary functions of stock markets include providing liquidity. Stock markets provide liquidity, allowing investors to easily buy and sell shares. This enables investors to execute transactions quickly and efficiently based on their demands. Capital raising for companies. Companies raise capital by offering their shares on the stock market. This capital enables companies to invest in growth, expand their operations, or pay off debts. Price determination mechanism. Stock markets provide a mechanism for determining stock prices based on supply and demand. The prices formed in the market reflect the value of companies and investor expectations. Risk diversification. Stock markets offer investors the opportunity to invest in a wide range of companies, helping them diversify their portfolios and mitigate risks. Stock markets play a crucial role in economic growth and corporate development. However, they also entail risks and the potential for losses for investors. Therefore, investors should conduct thorough market analysis and establish risk management strategies before engaging in stock market trading. 2. The bond market is a financial market where companies or governments issue debt securities that are bought and sold. Investors in this market purchase bonds, which are debt instruments, from issuers such as companies or governments, and they receive interest income in return. The bond market typically operates on securities exchanges but can also be traded over the counter, OTC. Bonds generally have a fixed term and pay interest periodically until maturity when the principal amount is repaid to the investor. During this period, investors usually receive a fixed interest income. The bond market serves as a means for both companies and governments to meet their borrowing needs. Companies often issue bonds to finance new projects or raise working capital, while governments issue bonds to fund public projects or bridge budget deficits. The bond market offers various advantages to investors. fixed income. Most bonds have a predetermined interest rate, providing investors with a fixed income stream. This allows investors to plan their future income. Diversification. The bond market allows investors to diversify their portfolios and reduce risk since it encompasses many different types of bonds with varying issuers, maturities, interest rates, and risk profiles. Liquidity. Bonds are generally liquid, meaning investors can buy and sell them easily. This enables investors to respond quickly to their cash needs and manage their portfolios effectively. However, the bond market also carries certain risks. Interest rate risk. There is an inverse relationship between bond prices and interest rates. When interest rates rise, bond prices fall, potentially causing losses for investors. Credit risk. There is a risk that the issuer may default on its obligations. In such cases, investors may lose a portion or all of their principal investment. Liquidity risk. Due to specific bond types or market conditions, it may be difficult for investors to buy or sell bonds at desired prices. The bond market stimulates economic activity while providing investors with a regular income source. Investors should tailor their bond strategies according to their risk tolerance, financial goals, and market conditions. 3. The Forex, foreign exchange. Market is a global financial market where different currencies are exchanged. In this market, participants buy and sell currencies with the aim of making a profit from fluctuations in exchange rates. Forex is often referred to as currency trading or FX trading. Forex operates 24 hours a day, 5 days a week, across various financial centers worldwide. Major trading sessions include New York, London, Tokyo, Sydney, and Frankfurt. This continuous operation allows traders from different time zones to participate in trading at any time. Key participants in the Forex market include commercial banks, central banks, hedge funds, multinational corporations, and individual traders. Transactions are primarily conducted electronically through trading platforms provided by brokers or financial institutions. Some key features of the Forex market include high liquidity. Forex is the largest and most liquid financial market in the world, with trillions of dollars traded daily. This high liquidity ensures that traders can enter and exit positions quickly without significant price fluctuations. Low transaction costs. Forex trading typically involves low transaction costs as there are no exchange fees, and brokers usually make money from spreads, which are the differences between bid and ask prices. High leverage. Forex trading allows traders to utilize leverage, meaning they can control larger positions with a relatively small amount of capital. While leverage can amplify profits, it also increases the potential for losses and should be used with caution. Global market. The Forex market is decentralized and operates globally, providing traders with opportunities to trade various currency pairs from different countries. This global nature allows traders to take advantage of diverse market conditions and economic events. When trading Forex, participants analyze economic indicators, political events, central bank policies, and other factors to make informed trading decisions. Technical analysis and fundamental analysis are commonly used to forecast market trends and price movements. However, trading Forex involves risks, including market volatility, leverage risk, geopolitical events, and liquidity risk. Therefore, it's essential for traders to implement effective risk management strategies and continuously monitor market conditions. Overall, the Forex market offers opportunities for traders to profit from currency fluctuations while providing liquidity and access to global currencies for businesses and investors.